Hi, I'm Dahlia, founder of Streetwise Mortgages. If you're currently feeling overwhelmed by the uncertainty in the real estate market and the sheer volume and pace of news relating to the lending, the credit, and the real estate landscape, I want you to know that you are not alone. I'm reaching out today to help you mute down the noise and also share with you a few key things that you need to be aware of heading into the next 12 months. This way, you can make an informed, not an emotional decision with respect to rates if you are planning on purchasing a property, and we're currently definitely seeing momentum on that front, or refinancing, or if you have a renewal coming up. First, let me paint a picture of the backdrop of the rate environment. Number one, the Bank of Canada signaled holding off any further increases to the overnight rate, and it did confirm its position by not raising the rates during the last Bank of Canada meeting. Inflation is easing up based on the CPI trends, although the labor market remains tight. Also, the collapse of the Silicon Valley Bank and the Credit Suisse in the US has created extra uncertainty about the stability of the financial system in the US and overall global concerns relating to bank liquidity. So with this backdrop, the rate hike cycle in Canada appears to have finally ended. And I know this is comforting for many. And currently, the market is expecting that the next move by the Bank of Canada to be a rate cut, likely in Q2 of 2024 and potentially sooner. Having said that, no one really knows the exact timing, but what we know is that a rate cut is now on the horizon. Cuts typically happen gradually to bring prime rate down, and they happen over time. And what's expected is that the cuts will eventually bring prime rate down by 100 to 200 points. We will unlikely see prime go back to what it used to be before the pandemic unless something significant happens and triggers that. Also, fixed rates have dropped over the past few weeks as the bond markets reacted to the uncertain credit environment. Right now, there is something really funky going on with rates. If you look up the fixed rate mortgages, you'll see that the 1 and the 2 and the 3 and the 4 and the 5-year fixed terms are lower than where the 5-year variable rate is currently. And the longer the term goes, the lower the fixed rate is. So that's an interesting observation. Also, the banking regulators in both Canada and the US are proposing changes that will result in tighter lending overall. So what does all of this really mean to you? Number one, given that a cut by the Bank of Canada is now on the horizon, I invite you to consider riding the rate roller coaster as it goes down, as this will save you interest and will help your cash flow. So how do you do that? Here is how you do it. If you're currently on an adjustable rate mortgage, as much as it's been painful for you to stay with an adjustable rate mortgage because your payments have gone up significantly as the Bank of Canada increased the overnight rate, sticking with your adjustable rate mortgage means that your monthly payment will go down immediately as soon as the Bank of Canada starts to cut down the overnight rates. And it will continue to do so every time the Bank of Canada cuts the overnight rate. If you're currently on a variable rate mortgage where the payment is fixed, but the allocation beneath the surface changes between interest and principal payments as the rates change, you will need to check your lender's policy because there is no guarantee that your monthly payment will go down as the rates go down. So if you want your payment to go down, consider switching to an adjustable rate mortgage. And definitely, in my view, I wouldn't suggest that you get into a variable rate product with a fixed payment right now, because you're going to lack that payment at the height of the cycle, unless the lender's policy says that they will adjust the payment as the rates go down. If you're going to make a new rate decision because of a renewal, a purchase, or an equity takeout, you may be tempted right now to take a long-term fixed rate mortgage because the rates are lower and they are also cheaper in the long term. And while that may serve you well in the short run, it will hinder your ability to benefit from lower payments when the rate starts to come down. So consider a 1-year fixed or a variable rate mortgage. Now, although I'm sharing with you the overall rate strategy, your final rate decision should be within the context of your financial situation and your personal plans, as well as the plans that you have for the property. This is why it is really important that you consult with a mortgage advisor to assess the suitability of the mortgage product and the term based on your individual plans and circumstances. Number 2, with the tighter lending guidelines on the horizon, consider increasing liquidity and restructuring any expensive debts that you may have. You can increase liquidity by setting up a secured line of credit or increasing an existing one that you have. Also, restructuring debts now will help you enhance how your balance sheet would look like for any future financing that is needed under tighter guidelines. My team and myself are here to help you. We are here to help you make the right and most informed rate decision as you move forward. We're just an email away. Email us at info@streetwisemortgages.com. We are here to support your success and help you move forward with certainty in this uncertain environment.